So hello again, my name is Greg Klein from Hayes Financial Group, and I'm happy to be with you today. Welcome back. If you've attended one of my webinars in the past, I always thank you for taking the time out of your busy day to join me and Hayes Financial Group in this presentation. This one's on one of your many options with your retirement savings. Once you get to the point of turning those savings into retirement income. So you see on the title slide, my name, you have my email address, so reach out to me with any questions. As I mentioned, I am recording this presentation, so I will send you a link to the recording. But in the meantime, use that chat feature. We'll have time for your questions at the end. I am not so good at multitasking, so I can't promise that I'm going to answer those questions on the fly, but we will get to them at the end. The topic of the presentation is this idea of a Social Security bridge, and I'll do a big lead up to explaining the concept of a Social Security bridge, what it is, why it might be something that could benefit you, maybe something that you've never considered. But older workers who are approaching retirement, they face a lot of complex decisions, and they come with pretty high stakes. They're making decisions at that point in their lives that could affect them for the remainder of their lives and multiple decades. And one critical decision is when to start Social Security. So it is worth your time to develop a strategy in optimizing Social Security in coordination with your 401k, 403b assets. And that's one of those options that we want to bring to your attention with this idea of a Social Security bridge. The agenda for the presentation is 4 parts. So first, we'll do a refresher of Social Security so that we're all on the same page and understanding Social Security, the basics, a little bit about how it works. I will put in a plug for another presentation that we have available on our website. You'll get the address to our website at the end. That's all on Social Security if you ever want to take time out to listen to that one. But after our little Social Security refresher, then we'll talk about the options that you have with your retirement savings, your 401k, 403b, and then we'll lead into introducing that idea of a Social Security bridge, what it is, how it might benefit you. And then finally, we'll wrap up with our contact details and time for your questions. That's the agenda for roughly 30 minutes or so of content, and then we'll have time for questions. Social Security refresher is the first segment, so we'll get into that. And we'll kind of level set on Social Security, make sure we're all on the same page. And I put on this title slide that Social Security is a type of annuity. And you're going to hear me use this term a lot in this presentation, is annuity. So I want to define what an annuity is when I refer to an annuity. And I say Social Security is a type of annuity because an annuity is a stream of payments, generally monthly payments that are paid out over your lifetime. That's basically what Social Security is. So we'll see in the presentation, there are a few different ways that you can get annuity income. With Social Security, you're paying your Social Security taxes in over your career, and then you turn that into a stream of payments when you reach retirement. So that's an annuity. Social Security is essentially a type of annuity. And you've probably seen this before. They refer to this 3-legged stool of retirement savings. Social Security is an integral part of that. You see, that's one of the legs. The other is your savings and investments, like your 401k, 403b. And then a third leg is a pension, which is a leg of the stool that most of us today don't have. So we're kind of working with, rather than a 3-legged stool, I'd say it's a little bit more like we're on a pair of stilts. And that might be what it feels like for a lot of us that were a little bit wobbly with our retirement savings situation. But Social Security is an integral part of your retirement income. It's that stream of payments, as we saw, that could also be referred to as an annuity. And as we'll see in some of these options, you might not have a pension, which is another stream of payments. You might have this, hopefully you do have this nest egg, these savings built up that you may choose to turn those into a stream of payments eventually. And we'll see some of the pros and cons of that. But what we want to look at first is with Social Security. So it's part of that 3-legged stool. What you can expect from Social Security might be more or less than this, but this is the average benefit for 2021. You'll see an individual about $1,500, a couple gets up to about $2,600, and that'll play into some of the hypothetical examples that we'll go through in just a couple of minutes. And with that stool that we saw, I mean, just looking at that image, you understand that Social Security alone is not enough. And then when we put numbers to that, you see $1,500 a month, that's not enough. And if we look at what retirees live on today, we see they're not living solely on Social Security. It's an important part of their retirement income, but it alone is not enough. What we have retirees living on today depends on their pre-retirement income. But you'll see in this chart, because they're no longer saving, they've transitioned into that deaccumulation phase where they're drawing down their savings. So they're no longer saving, and they can be in a more advantageous tax situation. So they might pay a little bit less in taxes. You'll see most retirees living on somewhere around 75 or 80% of what they lived on before they retired. Now, part of that will come from Social Security, even if we're working just with that two-legged stool. A chunk of that'll come from Social Security, that's in purple. And you see for individuals that make less income, Social Security makes up a bigger portion of their retirement income. Those individuals that make more money during their careers, Social Security may be a very small portion of your retirement income. And then to get us down to the bottom of that chart, so that gap that we're filling in is what's coming from private sources like your 401k, 403b. So that's why I say Social Security alone is not enough. Based on what retirees today are living on, you're going to need some of your own private savings from things like 401k, 403b. And these are very important decisions that you'll be making with those savings and with Social Security to get you the retirement income that you need to have. So next up, we'll talk about full retirement age for Social Security, or FRA. That's that age at which you're eligible for your full benefit. And I'll refer to it as like, you have a discounted benefit, your full benefit, and then maybe an enhanced benefit, because there is this range of ages when you can take Social Security. The younger you are, sure, the sooner you'll get Social Security, but the smaller your payment will be for the rest of your life. Full Social Security, would be your full payment. For most of us, it's going to be at the age of 67. If we want an enhanced benefit, if we want to get more, we can wait and take Social Security at 68, 69, even up to 70. Beyond 70, you don't get any more, but you can wait up to 70 and get an enhanced benefit and get a little bit more. And we'll see that in just a moment. But understanding that, what your full retirement age is, and what happens if you take it before your full retirement age, like at 62, which would be the earliest age that you can start to take it, what sort of impact that can have on your retirement income for the rest of your life. So I said we look at discounted, full, enhanced. And we saw that for 2021, an individual, the average payment is that one in yellow. They're $1,543 a month. But if they don't wait to their full retirement age, what if they want to take it right away at 62? You see what kind of reduction they're looking at. Rather than $1,500, we're talking about more like just $1,000 a month. If they want an enhanced benefit, they could wait beyond 67 and take it later, and they actually get a guaranteed 8% return with Social Security for each year that you delay up to age 70. It's a guaranteed 8% more that you'd be getting in that monthly benefit for the rest of your life. And then there are cost of living increases that Social Security does add on to that. So remember, those annual cost of living increases for Social Security are based on that payment. So if you wait, get a bigger payment, then those cost of living increases are going to be more. But you see there the difference with the range. This person taking it as soon as he or she can at 62, about $1,000. If they take it for that enhanced benefit and try to get the biggest payment a month for the rest of their life, at age 70, we're talking about almost double, almost $2,000 at age 70. So that's what happens based on your full retirement age. If you take it younger or older, how that impacts your benefit. What do most people do? Well, this gets into a little bit of our behavior and how when we make financial decisions, sometimes we make them a little bit more with our heart, less with our head. We're a little bit more irrational, and we might have some of those biases creep in, like a present bias where you just want the money now. Waiting, even if you get more for waiting, you don't want to wait. You just want to take it as soon as possible, and that might be a valid reason to make that decision, based on your health, based on your situation. And that's what a lot of people do. You see that a lot of people take Social Security right away at 62. But what we want to get at, we want you to be educated, understand what your options are, and how taking Social Security at a more advanced age could potentially benefit you. So make an informed decision based on your situation, but understand the impacts of taking Social Security younger rather than older. I don't know if all 41% of those people that took it at 62, understood what they were getting into or just wanted to get the money as quickly as possible. So we want you to be very educated and understand what your options are. And we'll look at your longevity probability. So how long could you potentially be alive? Because if you, take that payment at age 62, just to get that money as soon as you can, you might not realize at that time when you take that payment at 62 that you could be getting a smaller payment for 20, 25, 30 years, where waiting a handful of years could give you a bigger payment for the remaining 2 decades of your life. If we look at women, first of all, you see that women have about 1 in 3 odds of making it into their 90s or beyond. Men about 1 in 4. If you have male-female couples, one of you, so there's about a 50-50 chance. If both of you retire, male-female couples, if both of you retire at 65, about a 50-50 chance that one of you is going to make it into your 90s or beyond. So pretty good odds that you're going to spend retiring at 65. That'd be 25 years plus in retirement. So a decision that you make in your early 60s can impact you for a long time still. And, the trends continue. If it's female couples, females tend to live longer. So if you're looking at a female couple, the chance is even greater, like 60% that one of you is going to make it into your 90s. If you're a male couple, again, the odds work against you a little bit less chance that one of you is going to make it into your 90s. But something to seriously consider when you're making those decisions about taking Social Security and what to do with your 401k, 403b savings. So that's where we'll transition then into segment 2, your options with your retirement savings. To understand how a Social Security bridge might fit into these options, we want to look at, so what are your options to begin with your 401k? And one of those options is to annuitize. So here we hear this term again, an annuity. You can annuitize now. So start that stream of payments right away at retirement. That's one route that you can take, turning your nest egg or your 401k, 403b savings into a stream of payments for the rest of your life by annuitizing right away. You can annuitize a couple of different ways. So you can annuitize now by what's called SelfAnnuitization. That is what a lot of us think of with our 401k, 403b savings, is just drawing that down slowly over time and drawing that down over, as long as we're going to be alive in retirement. Okay, there are some advantages to self-annuitization, just drawing down your retirement savings on your own. And one big one is you retain control. So if you don't like the idea of turning all your money over and turning it into a stream of income by giving it to a financial institution, you just want to do it on your own. You might like that control because you think you can, make a better return than the financial company is going to give you. And so you might like to maintain that control. More power to you. That's an option for you. So you can self-annuitize. The disadvantage or the con is going to be then you do retain the risk. So you have the control, but with that control comes that market risk. So you are responsible for making that money last as long as you're going to be alive. And you got to work with the ups and downs in the market. You're going to be retaining that risk. If you spend too much, too quickly, invest too conservatively, you might run out of money, or you could spend too little. And then if you don't want to leave a bunch of money to your heirs, you maybe didn't spend as much as you could have with those early years in retirement when you're still able to do things, travel, spend time with your family, whatever it is you look to do. So some pros and cons of that self-annuitization, drawing money down on your own. Another option for annuitizing now would be to purchase an annuity. So you take that nest egg, that lump sum of 401k, 403b savings that you have, and you give it to a financial institution, like an insurance company, and you buy an immediate annuity. So that is turning your money over to them. Then in exchange, they're going to give you a stream of payments for as long as you're alive. The advantage of an option like that is it's a fixed amount, so it helps with budgeting and planning. There's some people, they're okay giving up the control in exchange for knowing I'm going to get this monthly amount for as long as I'm alive. And then that with Social Security, I know what I'm going to get every month, and no doubt. So I can easily plan. So that might be an advantage for some people. It eliminates the market risk. You're turning that over to a financial institution to start that stream of payments. Then it's up to that financial institution to make whatever return they need to pay you that monthly income every month. You no longer have that market risk. So that you might find that attractive. On the con side, there are higher costs. So with giving up that risk, there's a cost associated with that. So you might forego some investment returns. That is where you might be able to make 8 to 10% a year on your investments, where the financial institution, for waiting a year, let's say, to take that annuity out or buy that immediate annuity, they might only pay you 5 or 6%. So there's a cost associated with that. You're giving up the risk, but you're giving up that control, might forego some return. The biggest one, probably why a lot of people don't look at annuitizing their nest egg, is just that loss of control. It's more of a behavioral thing. We don't want to give up the control. We have that loss aversion where we think, well, what if I buy this annuity and then a handful of years later I die, so I lose out. I didn't collect on this annuity for very long. So there's that loss aversion. So pros and cons, but annuitizing now on your own with self-annuitizing, or buying an immediate annuity. Annuitizing later is also an option. And so that would be, annuitizing later would be buying what is referred to as a deferred annuity, or an advanced life deferred annuity. That's a stream of payments. So you see that word annuity, a stream of payments, but that are going to start at an advanced age, like 65. So this creates a fixed amount of time that you need to make your savings last. You're going to get this stream of payments starting at 85. So now you're working with, if you're retiring at 65, just needing that money to last from 65 to 85. And that might help with your planning. So some pros of this, they call this longevity insurance. You're buying the stream of income that's starting at 85. So if you do live to be very old, you have this insurance. You know you have this money coming in that's going to kick in at 85. So you'll be okay. You won't be penniless. If you spend everything, by the time you reach 85, you still have this deferred annuity income coming in. You'd still have your Social Security. So you're going to be okay. So that might be an advantage. And then they are lower cost, as we'll see in just a moment. So we looked at that immediate annuity and then a deferred annuity. So starting the payments with an immediate annuity at like 65, is about 5 times the cost of starting that stream of income at age 85. Because think about it from the financial institution's perspective, if you're not starting to collect on that income till 85, there's less of a chance that they're going to have to pay out on that at all or pay out for very long. So they'll sell you that stream of income a lot cheaper. The disadvantage is, of course, just that you might not collect on that if you don't make it to 85. Maybe you don't collect on that deferred annuity. That might be a hurdle that's just too high for you, and you don't want to look at that sort of option. Then we get into this bridge concept. So we are up to speed on Social Security, what our options are with our nest egg when we get to retirement to turn it into income in retirement. Then we start to introduce the Social Security bridge. And that the bridge is this idea of using a portion or all of your nest egg, all of your 401k, 403b private savings that you've accumulated. And maybe it's not as much as you would have hoped to accumulate by the time you retire, and you're afraid that this money can't get you through the rest of your life. So what you do is you say, I'm just going to build a bridge with these savings to get me to a more advanced age and take Social Security at a more advanced age to increase that Social Security payment for the rest of my life. So now my savings only have to get me through a handful of years, at which point I can start to collect on a higher Social Security payment every month. This might be right for some people, it's another option, but to better understand how these options might benefit you and look at what these might be in terms of income, we want to look at some hypothetical scenarios. So to do an apples to apples comparison, we have to have this hypothetical person, a 65-year-old male retiring $115,000 in retirement savings. Remember, we saw average Social Security in 2021 this year is about $1,500, but they're not going to be at full retirement age. They're going to be at 65. So they're taking the payment at a discount. They just want to retire now. They want to get out at 65. So they'd be taking something like $1,300 a month in retirement income from Social Security. So we'll look at these different scenarios. The first one is buying that immediate annuity. So we want to see if we gave up control of our retirement savings and we just wanted to annuitize everything. We want this guaranteed stream of income that's coming in every month for as long as we're going to be alive. What would it look like if we turned that $115,000 into an annuity and then added in our Social Security? And you can see there, I plugged in my state, and I didn't point this out on the previous slide or one of the previous slides, but you can go to immediateannuities.com and you can plug in age, how much you'd be buying or what your nest egg is, and it'll spit out what you get as far as annuity income. So this person, about $459 plus $1,300 or so in Social Security, they're up at like almost $1,800, about $1,797 as far as monthly income that they would have coming in for the rest of their life from Social Security and their annuity. So that's sort of like our base case. Let's say they don't want to turn that control over. They don't want to buy an annuity because they don't like that idea of losing control. So maybe they're going to look at another strategy. And you may have heard this term before with these required minimum distributions. So this is this required amount that the IRS forces you to take out of your pre-tax savings every year in retirement because they want to start to collect taxes on some of those savings. So maybe you just go with that amount. You're like, well, I'm going to have to take this minimum distribution. Maybe I'll do something like that. And you see that ends up being, those don't actually have to start until later. Those required minimum distributions don't have to start until now it's age 72. But if this person started to take them at 65, maybe about $350 that they'd be taking plus their Social Security. So now they're in that 1688 range. The advantage is money's not going to run out. So if you just go along the lines of that retired minimum or required minimum distribution, it's not going to run out, but you have less retirement income, you see, versus annuitizing and giving up the control of that to get a little bit higher payment each month. So $100 a month, that can impact your standard of living in retirement. Maybe you want to just target a high age. Like if I live to 100, I want to make this money last to 100. Again, invest it conservatively. You could still run out of money. You could still live past 100. But let's say you're investing this $115,000, pretty conservatively. You want to make it last 35 years to age 100. You'd be looking at, again, in that same range, 300 plus from your savings, 1,300 plus from Social Security, and in like that 1,700 a month, 1,750 range. You want to keep control. You're going to invest conservatively. And you say, I'm not going to run out of money. All right, hopefully I won't if I invest conservatively. But if you're drawing down, you see an annuity will pay you $459 a month. You're like, I don't want to give up that control. I'm just going to draw down $459 a month from my savings. I'll invest conservatively to try to make it last and see what happens. And in this case, investing conservatively right now, if you're going into like bonds, corporate bonds, they're paying about 3%. So if this person is making 3%, for the remainder of their retirement, and they draw down $459 a month to get the same amount that they would get from buying that annuity, they're going to get the same monthly income, but they end up running out of money. They end up running out at an advanced age, at about age 88. So maybe they look at that deferred annuity option, where they take a chunk of their savings, buy an annuity that's going to start at an advanced age, like 85. You see, it doesn't cost them as much. They don't have to take all of their savings. It's going to cost them about $16,000 to buy that $459 of income at an advanced age, like 85. So now they know they have $99,000 left. They need to make that $99,000 last from 20 years, from 65 to 85. Then their annuity is going to kick in at age 85. And you can see, that gets them in that same ballpark. They don't have to give up control of all their money by buying an immediate annuity. They could just take about a fifth of it, or even less than a fifth, a little chunk, buy a deferred annuity. And now they know that deferred annuity is going to kick in at 85. Now they just have to make their savings last for 20 years to get to that deferred annuity. And then finally, we bring in the Social Security bridge that we've talked about. So what if they, instead of doing all these other options, they say, okay, I'm going to take my nest egg, my savings, and I'm going to live on that first from age 65 to 70. I'm going to take Social Security at a more advanced age of age 70, because I know if I take it at 70, I'm going to get $1,900, a little over $1,900 a month. And that's going to be for the rest of my life. So now I know at age 70, I'm going to get $1,900 a month. What I can do now is live off that same $1,900, but start with my savings and draw down my savings $1,900 a month. That's going to get you, in this case, like this individual, it's going to get him through 5 years and get him to age 70, when he would start to get that higher Social Security benefit. So that's that bridge. Now he's just taking his savings and making them last that 5 years to bridge from 65 to 70 and get a higher Social Security payment than starting at age 70 for the remainder of his life. Now, the bridge, what you're doing with that bridge is you're essentially buying annuity income, but from Social Security. So rather than buying a deferred annuity or an immediate annuity from a private company, rather than self-annuitizing, you're buying additional income from Social Security. You're saying, I'm going to wait. I'm not going to take it right now, because if I take it at 70, I'm going to get a higher payment. And instead, I'm going to live off of my savings right now to bridge to that higher Social Security payment a handful of years from now. And so the big advantage is that's guaranteed extra income. So if you delay a year, it goes up 8%, guaranteed. So you don't have to worry about creating that return on your own. So that's an advantage of using a Social Security bridge. Not to mention those cost of living increases. So Social Security then is going to increase with the rising cost of living. That's automatic, included in Social Security. In other types of annuity options, you have to pay for those cost of living, or that cost of living increase advantage. You're going to pay for that. Social Security, it's included. This one might be a little bit hard to wrap your head around, but Social Security does pay a little bit better. They give you that guaranteed increase of 8% because they're looking at the entire pool of individuals. With annuities, if I go to that website and I go to immediateannuities.com and I plug in my information, say I'm age 65, what do I get with my 401k, 403b savings if I start that annuity today at age 65? And then I look at, well, what if I wait a year and I start at age 66 instead? It's probably only going to go up around 5%, where you see Social Security goes up 8% guaranteed a year. And that's because with annuities, what you end up with a lot of people that expect to live a long time looking towards buying those annuities. And so you don't get as much of a bonus from that pool of people from the financial institution as you do from Social Security. If you wait a year from Social Security, you get 8% because they're actually looking at everyone, not just those people that are looking to live the longest. So, if you live a long time, you benefit from that from Social Security, and you benefit from waiting a little bit to start your Social Security payment. And then what is our last one? All the Social Security, a portion of it's not subject to taxes, or even states that don't tax Social Security benefits. So there can be some tax benefits by having a higher Social Security payment because it is treated differently for tax purposes. And then there's the automatic spousal benefits, as we'll see in just a moment on some slides that I have about waiting or taking Social Security right away. This is not a decision perhaps that you're making alone. Postponing and taking Social Security at a more advanced age could not only benefit you by giving you a higher payment, giving you peace of mind with knowing that you just have to bridge, a handful of years, but also for your spouse. Because if you're the higher income earner and you pass away, well, your spouse gets spousal Social Security benefits that's included in Social Security, not like other types of annuities where you have to pay extra for that joint life type of benefit. It's included in Social Security. And then your spouse would be able to pick from his or her benefit or your benefit, whichever is higher. So that's something to consider as well. So maybe, consider taking your benefits right away. Don't worry about a bridge. If you just are struggling to make ends meet, you might have to just take Social Security. You can't try to bridge to taking it at more of an advanced stage. That's understandable. Maybe you're in poor health and you just, you don't think you have a lot of years left in you. Maybe just taking Social Security right away, don't worry about a bridge. That might be the right course of action. If you are the lower income earning spouse, you could take your Social Security early because, again, your higher earning spouse, if he or she delays, well, again, if he or she passes away, you're going to get the choice to take either your smaller benefit or take their bigger benefit, with your spousal benefit. So if you're the lower earner, it's not, there's no disadvantage to taking that benefit early. But the higher earner, yes, very well, may want to look at a bridge or something like that and postponing taking Social Security, because that's going to impact the spousal benefit as well. But if you're still working, if you're in good health, expect to live, a long time in retirement based on your family history, yeah, you might want to wait. Something like just waiting to take your Social Security, or waiting and using your savings first and bridging to a bigger Social Security payment, that might be advantageous for you. So some of the takeaways and all that we've been through with Social Security, perhaps building a Social Security bridge, is that it's another option. Maybe it's an option that you hadn't considered previously. Maybe you only thought about like that self-annuitization, just drawing down your savings on your own, or just taking those required minimum distributions, something like that. Maybe you considered turning your nest egg into a stream of payment by buying an annuity, but you didn't think about a Social Security bridge. Well, this is just another option for you that we want to educate you on. There are, some of those advantages, like I talked about, buying additional annuity income from Social Security because of the guaranteed 8% return, the cost of living increases, the integrated spousal benefits from Social Security. So there are some advantages, but it does tend to work better for, we'll say, average individuals. So individuals that are more average income, not higher income earners. They say in like that 50th to 70th percentile. So if you're like if you're a 1%er, yeah, Social Security bridge is not certainly going to be the right strategy for you. But if you're more an average Jane or Joe, and this might work for you, if you have more than $250,000 in retirement savings, yeah, Social Security bridge might not be the right option. But if you have, like we saw in those examples, maybe you have $100,000, it's going to be hard to stretch that $100,000 out over an entire retirement, but you get some peace of mind by thinking, well, I don't have to stretch this $100,000 out forever. I can just use that first, get me to age 70, and then I can have a higher Social Security payment for the rest of my life. If that's something that's attractive to you, that's the type of person that a Social Security bridge might work for. So then, questions, we'll get to some of your questions. If you want to start typing those into chat, I'll stop the recording, but you have our contact information, my email address again, our website where you can go and listen to that full Social Security presentation if you want to do that. Our phone number, the QR code, that'll get you to our scheduling page if you want to talk about this more one-on-one. That's part of the services that we provide on your retirement plan. So scan that code, that'll get you to our page.